So whenever any of the accounts that you're using isn't part of the accounting equation, you can measure it on equity. Is an expense going to, what is it going to do to equity? It's going to reduce equity. Today, I want to walk you through the evolution of my understanding of debits and credits. And you're going to want to stay till the end, because at stage 3, this is where the magic happens. This is where you can record any business transaction without having to memorize any kind of weird acronym, right? This comes from pure understanding of what's going on in accounting. So without further ado, let's dive right in. All right, if you're new to the channel, welcome. My name is Bill Hanna. I'm the financial controller. I'm a licensed CPA in the great state of New York, and I have been working as a controller for the last 18 years or so. And I share my knowledge here in terms of free content in YouTube, but also in terms of premium content on my website in the form of coaching and online courses. So go ahead and check that out. I'm going to leave a link down below. So when we talk about the stages of the evolution of my understanding of debits and credits, the first stop here is going to be strangely enough, the third law of motion by Sir Isaac Newton. So the third law of motion by Sir Isaac Newton says that for every action, there's a reaction that's opposite in direction and equal in force, right? So think of a rocket that's taken off. When the rocket is taken off, the hot gases are being pushed down and the rocket is being propelled into space. In the same way, when we're talking about debits and credits, and this is how I learned it from my professor in college, when we're talking about debits and credits, you have one action. Say you receive some cash, so you have some cash, right? Cash came in through the door, and this is going to create a reaction. Now, this reaction is going to be equal in amount. So if the cash is $1,000, your reaction is also going to be $1,000, right? That reaction is going to be equal in amount and opposite in direction. So if the cash is an increase, which we call a debit, you're going to have opposite in direction, which is a credit. Now, this cash that came in through the door could be in the form of sales. So if you have sales, right, then your credit is to revenue. Or it could be in terms of stock. So maybe you have a new business and you sell stock. Maybe you go on Shark Tank and you sell some stock in your business. You get some cash that come in through the door, hopefully more than $1,000. Right? So you have stock that's coming in, so the credit is going to be to equity, right? Or maybe the $1,000 is a loan, right? So maybe the shark on Shark Tank that made you the offer is Mr. Wonderful, and he's giving you a loan instead of equity, right? So in this case, you have a loan, and this is going to be a liability, right? So this was the first thing that I learned about debits and credits in college, is that it's similar to the third law of motion by Sir Isaac Newton. For every action, there's a reaction that's opposite in direction and equal in amount. So that was my first understanding of debits and credits. Now, let's go ahead and talk about the second stage of this evolution. And the second stage came in the form of an acronym. And this is something that I learned when I studied for my CPA, and I took one of my favorite CPA review course, which is Roger CPA review course. So I learned the acronym dealer. So dealer here is going to guide my debits and credits. So let me put the credit up here, and the debit always goes here on the left. So when we say dealer, D-E-A-L-E-R, D is for dividend. The E is going to be for expenses. A is for assets, right? L is for liability, E for equity, R for revenue, right? Which means that dividend, expenses, and assets have a debit nature. So to increase them, you gotta debit them, right? So to increase them, you're going to debit them, right? Whereas liability, equity, and revenue, they have a credit nature, and to increase them, right, you gotta go ahead and credit them, right? And vice versa. So if you wanna decrease an asset, then you're going to credit the asset. If you want to decrease one of these, liabilities, equity, revenue, then you're going to debit that. So this comes in handy. It's an acronym you memorize, right? And you go ahead and apply it to any example. So if you have a salary spend of $5,000, right? Then it's easy. Then you have a cash going out the door. So cash going out the door, you want to reduce cash, which is an asset. You credit that. So you do a credit to cash for $5,000, right? And you have to have a reaction to that. So the reaction is going to be an expense. So the expense here, to increase it, it's a debit, right? Expense. So you go ahead and you debit expense for $5,000, right? Equal in amount and opposite in direction. Okay, so this was the second stage of the evolution of my understanding. A simple acronym, right? Nothing much to it. You just memorize it and you apply it to any business transaction. Now, I want to walk you through the third stage of that evolution. That happened more further down in my career when I became more seasoned as a more experienced accountant. So let's talk about that. Now, for the third stage of the evolution in my understanding of debit and credit, this came down the line. Now I'm more of a seasoned accountant. I have more experience under my belt and I understand how the accounting equation works. So the accounting equation, if we draw a scale, right? On one side we have assets and it's always equal to liabilities plus equity, right? And the reason why they're equal is because assets is what we own, right? It's always equal to what we owe as a company. So what we own, all the assets, inventory, cash, accounts receivable, stuff we own. Here, liability, we owe that to third party, and equity is owed to shareholders. All right. So what we own equals what we owe. Very simple. So if you believe that, and then you believe that assets are going to be a debit, right? And the other side of the equation must be credit, because this is what we talked about before. For every action, there's a reaction that's going to be opposite in nature, right? So we have a credit on this side. Then, if you believe that, then you can record any kind of business transaction without having to memorize any acronym. So to give you an example for this, if you have an expense, let's say a marketing expense, for $1,000, then your two sides are going to be an expense and an accounts payable. Now, which one is a debit or credit? Well, let's look at this. Let's look at the accounting equation. So an expense, you don't see expense here. Expense is not listed here, right? But an expense is going to decrease equity, right? So it has the opposite nature of equity, right? So you can measure everything on equity when it's not listed here. So an expense is going to reduce equity, therefore it goes against the nature of equity. So an expense in this case is going to be a debit. Accounts payable, you want to increase a liability where the liability is right here. It's a credit, right? So that's easy. You're going to go ahead and credit this liability. Let's look at a different example. Let's say you sold $1,000 worth of inventory with a cost of $800. Okay, so we have here two transactions. We have the sale transaction and then we have the cost of the goods sold, right? So for this, the first transaction is a sale, right? So you have revenue, right? And then you have cash or accounts receivable. But for simplicity, let's just call it cash, right? So which one is debit and which one is credit? Well, revenue is increasing. Revenue isn't here, but we can measure it in equity, right? So because revenue is going to always increase equity. So when it's increasing equity, then it's going to have the same nature as equity, which is a credit in this case. So it's a credit to revenue, and it's going to be a debit to cash to increase the asset, right? And that's for $1,000. So this here is for $1,000. And now we have to record the cost of goods sold transaction. The cost of goods sold transaction is going to have two sides. It's going to have inventory on one side, and it's going to have cost of goods sold on the other side. So we have inventory And then we have cost of goods sold. Now, which one is debit, which one is credit? Well, inventory is an asset here, right? Are we decreasing that asset or increasing that asset? Well, inventory here is being decreased, right? So you're gonna have to credit that, right? Cost of goods sold is a cost or an expense. So an expense, the nature of it, look at equity. What is cost or an expense going to do to equity? It's gonna reduce it. It's gonna have the opposite nature then. So this one is gonna be a debit, right? So whenever any of the accounts that you're using isn't part of the accounting equation, you can measure it on equity. Is an expense going to, what is it going to do to equity? It's going to reduce equity. So it's going to be the opposite nature. Revenue, what is revenue going to do to equity? It's going to increase equity, right? What is, for example, if you have dividend, let's say you have a dividend transaction, right? A dividend is going to also reduce equity. So it's going to have the opposite nature of this, which is going to be a debit, right? So that's why understanding it in this way is going to help you think through any business transaction versus memorizing an acronym like dealer. It's okay to memorize dealer for the time being if you're starting out, but as you get more experience, you're going to want to learn this a bit more. So I hope you enjoyed the video, and if you did, go ahead and hit the like button and share this video with someone else who's going to learn from it. And I'll see you on the next one.